What's up everyone, it's Karthik with MoneyVest. So this is going to be your technical update for the Magnificent 7 stocks, as well as a full technical breakdown on S&P 500 and the NASDAQ, and what levels to really pay attention to going into next week after witnessing almost over a 4% sell-off for the S&P and the NASDAQ. So pretty brutal week. We definitely did have the first week of September starting us off with an aggressive sell-off, well over $2 trillion worth of market value basically erased from S&P 500, and Magnificent 7 also selling off very aggressively with a lot of stocks, trading down below their moving averages. The MoneyVest index also crashing down from well over 4 down to now 3.4, so definitely selling off below 3.5. And then we also did have volatility, of course, jumping over 49, as much as 50%. For the past week. So this video, I'm going to break down exactly what to expect, what levels to really pay attention to very closely for individual stocks, including the Magnificent 7. So hope you all enjoy it, find it helpful. Make sure that you drop a like and subscribe to the channel. I would really appreciate that. We're closing in on 84,000 subscribers. Our goal is 100,000 by the end of this year. So help us get to that goal. I would really appreciate that, and share this video with other traders, investors that can benefit from this update. So this is the technical dashboard that we have created for individual sectors as well as individual stocks. And if you see red, that simply means that that particular stock or ETF is trading below that particular moving average. And if you see green, that means we are still above that moving average. So the more red you see, that means we are trading below several of our moving averages. And we've got the 5, the 9, the 21, 50, 100, and 200 SMA. So that is a lot of simple moving averages, and they all range from short time frames, 5, 9, 21, to as much as longer time frames, right? So 100 and 200 SMA, and 50 is kind of like in the middle. And so it basically helps us understand the short-term, medium-term, and long-term trend for whatever it is that we're looking at. So for example, if you come over to Magnificent 7, Apple is below its 5, 9, 21, and 50 SMA. So Apple, of course, has been selling off a little bit here, still above the 100 and the 200 simple moving average. That simply means that the long-term trend is still intact, but short-term, definitely struggling. NVIDIA, we've got NVIDIA down across the board, except still above its 200 simple moving average, so that is still intact, longer-term trend, but of course, definitely very, very weak, as a lot of the market cap losses came from NVIDIA in the past week. Google, very weak across the board, Google and Amazon, both of these companies, as well as Microsoft, so those are the 3 stocks that are incredibly weak from a technical standpoint, because they're down not only on the 5, the 9, the 21, 50, even the 100 and the 200 simple moving average. So those 3 stocks are down across the board. And Tesla was actually one of the best performing stocks up until Friday, when it sold off very aggressively. It was, up across the board from 5, 9, 21, 50, 100, and 200 simple moving average. It is still above the long-term trend, but definitely sold off very aggressively on Friday and broke down from its short-term moving averages. And Meta, very similar to Tesla, is down between 5, 9, 21, and 50 SMA. Still, the long-term trend is pretty intact. And the same thing is true for the indices. S&P 500 was doing much better up until last week, and we broke down below the 5, 9, 21, and 50. NASDAQ is taking a little bit step further. It's also down below its 100 simple moving average. Same thing is true for NDX. Russell 2000, very similar to S&P 500, and the Dow Jones, probably the only index of the 3 that is still trading above its 50 simple moving average. So the medium term is still okay. Short term, of course, not that great, because there was mass selling pressure across the board, but the medium term is still relatively decent. Now, where's the money going to? Well, there's a couple different places. Up until last week, though, we did have places like gold. We had utilities. We have staples. We have definitely real estate. And then we also had places like healthcare and, of course, our TLT, which is the bond market. That's where the money is rotating into, right? So we're seeing it come out of technology, out of discretionary, out of semis, out of equities altogether, and it's been going into places like gold, bond market, and then within equities, we've seen a rotation into utilities, staples, real estate, definitely. Then we've also had healthcare, although on a more last week basis, healthcare, staples, utilities also did pull back. But that's where the money's been rotating into, right? So we've already talked about how the markets are getting very defensive. And this is a sort of a positioning from the market, which is a risk-off positioning, where the markets are getting ready for what could be a very uncertain market environment, considering that there's elevated fears around recession, elections are just right around the corner, as well as inflation data and the Federal Reserve meetings. So there's a lot on the deck for the markets. And, because of that uncertainty, a lot of investors are just straight up sitting out this market and kind of rotating into more safety, which is bonds, gold, and utilities and staples. So if you come over to the charts, and first things first, let's talk a little bit about the Money Vest Index. I gave you guys a warning couple days ago. I think it was like last week or something. It was, I believe, last Friday. So before September started, I essentially did a video. This is your September warning. I did that video last weekend, talking about how the Money Vest Index is well over 4.05. So we're well over 4, something that we haven't seen in a very long time. So this was the level, and the last time you saw that was back on July. And of course, we ended up selling off quite aggressively. That is essentially where, the entire blow up of the carry trade started. And then we kind of bottomed out here on Monday, August 5th, and then a very, very sharp reversal back higher, getting up to over 4.05. And also highlighted the very fact that in the past, every time we have been a little bit over 4, eventually what's happened is that we have come down. There's been selling pressure in the markets eventually, sooner or later, every time we have been, well over 4. So I think it's really important for us to always remember that, this Money Vest Index, it's very carefully crafted, and the calculation is based on a lot of different technical and volatility metrics so that we can better understand the positioning of the market. So the fact that it's now in the yellow band, right, so in the middle, in the neutral zone, definitely does suggest that we have de-risked quite considerably, and that makes a lot of sense because the markets are also down, right? So if you come over to S&P 500, this right here is what it looks like from the last few days. If you come over to the weekly time frame, this is the candle that is, of course, really, really brutal, down a little bit over 4%. So definitely de-risked quite considerably as the Money Vest Index has also come down. So what I'm going to be waiting for is, once again, levels such as like these, right? So I'm really waiting for levels closer to 3 or sub 3. Now, we don't know if we're going to see that level or not. We don't know if this selling pressure is going to accelerate. Nobody really has the answer to those questions, right? So nobody knows where the markets are going to bottom. How long is this sell-off going to last? But what we can do is better understand where the risk reward is going to be optimal for us. And the way I look at these sort of different areas of the Money Vest Index is over here, the closer it gets down to 3, the better the risk reward becomes, and then I can start nibbling into the market. This is not areas right now where it sits at 3.44 is not an area where I want to be very aggressive, right? I want to be somewhat excited about the deals that are coming my way, but this is not a level where I'm getting super excited about deploying a lot of capital. So you really need to have like a approach where you go from top to bottom in terms of how aggressive you want to be when it comes to dollar cost averaging into the market. And at the very top, between 4.5 and 5. So if you are, let's say, in this band, you want to be extremely cautious. This is a level where you want to be extremely alert and cautious because the risk reward is the most unfavorable if you're between 4.5 and 5. If you're between 4.5 and 4, right? Again, you want to be very careful. You want to be extremely cautious in and around those levels. The risk reward is really bad if we are inside this red bands, right? Anything between 3.5 and 5, the risk reward is not that favorable. We just entered the yellow zone, which is a little bit more neutral, right? So risk reward isn't bad, but it's also not great, right? So you want to be a little bit more patient here. And the moment it drops to 3 or sub 3, and for a very brief moment, back on Monday, August 5th, I literally mentioned this in our Discord as well, we were down to 2.95, but that was only there for a solid 1 hour. We were only there for 1 hour only because the markets kind of stayed there for an hour, and the volatility just absolutely got crushed from 65 down back to 30 by the end of that day, and the Money Vest Index was back over 3. So the moment we cross below 3, deals start popping up. There's going to be a lot of discounts and bargains left and right, and once again, 2 to 2.4, now you're dialing up on that risk reward. It's getting better and better, and you want to be a little bit more aggressive, and you want to be extremely aggressive. That's what I like to do, is to be extremely aggressive the moment the Money Vest Index dips below 2, right? If it's trading between 1 and 2, you better believe it, the markets are going to be down quite substantially from their all-time highs. I mean, in this area, my expectation is for the markets to be in a full-blown bear market, for volatility to be well above 50, for a lot of other metrics such as the market breadth indicators to be really, really extremely low. In other words, a very technical oversold condition for the market, which I'm also going to break down here now. So keep a close eye on where the MoneyVest index goes. We have definitely seen significant de-risking in the last week. I sent out a warning here when the MoneyVest index was well over 4, and now this is just an update from where we have been and where we are now. In the past week, significant de-risking, but we are still in the neutral zone. This is not a level where I want to be super aggressive. It's a level where I want to allow the prices to come to me and let the prices come to you, right? So be patient. Now, this right here is the technical indicators, and I also mentioned in that September warning where we were with the percentage of stocks trading above their 20 simple moving average. So historically, once again, boom, right here, you can see that every time we've kind of come up to this 85 to 90% level, eventually what has followed? We've seen the markets rotate back down. This is just how markets move. They move in cycles. Stocks become overbought. Then we cool off. Stocks become oversold. Then we rip back higher, right? So that's how the markets move in cycles. And we are now down to 43%. We were at 90% last week, right? So when I sent out that update on Friday, Saturday, we were over 90%. So that means half, right? So half of the stocks, over 50% of them, have now sold off so much that they are now trading below their 20 simple moving average. And if you essentially take a look at where this indicator essentially bottoms out, I mean, it can go as low as less than 1%. So there you can make a case that, okay, there's a lot more downside left. But again, in the past, if you really just kind of zoom in a little bit, so let me just bring this chart further, you can take a look that it's not always that we come down to under 1%. Sometimes we kind of find a bottom at around 30%. So that 30% threshold would also be a very important indicator for short-term weakness and technical oversold conditions for the market. So we still have a little bit of ways to go. I think next week there is a possibility that the first half of the week we continue to see the sell-off, some more acceleration, and there's going to be buying opportunities. I think there's going to be buying opportunities in the market going into next week, considering that there is possibilities for us to see some accelerated sell-off, but then some buyers stepping in. There's going to be oversold levels for the market, and in my opinion, there's going to be bids coming back into the market. So far, we haven't seen any bids, no buyers present. Tuesday and Friday was quite brutal. On an intraday basis, because we continued to see a lot of weakness, lower highs, lower lows throughout the day. There was no buyers, no bidders whatsoever. But I do think that next week there's going to be someone stepping up, courageous enough to start buying back into the market, given how oversold we are now starting to become. So keep a close eye at some of these indicators. I think they're going to be very, very important, especially when you look at the 50 simple moving average and the 200 simple moving average. Sure, you can make a case that, okay, this sell-off is nowhere near close to being done. There could be more potential downside, and I would not be arguing with you because nobody really knows how long or how severe this is going to be. And that's exactly why I really want you to be patient, but also take advantage, right? If the markets are coming down, I'm going to be deploying some cash going into next week, and it will continue to dial up, right? So really the idea is to take it slow and then continue to increase that aggressiveness with dollar cost averaging and buying as markets continue to come down, because as prices come down, risk comes down with it. So going into next week, what are some of the levels that I really want you to watch? Coming over to the S&P 500 first, the first level is going to be closer to 5,200. Actually 5,400, excuse me. 5,400 is going to be that level. That's going to be right about there. And the reason I say that is because if you come over to the 4-hour chart, you'll notice that we kind of consolidated sideways at those levels for some time. So this right here was a lot of consolidation, a lot of back and forth here before finally breaking down. And this right here was also another time that we validated 5,400 before pushing higher, consolidated sideways again, and then broke out to new all-time highs. So that's where the S&P is coming down to. Now, you can also make a case that, we just made a lower high for S&P 500 because we obviously did not go as high as we did the previous time. So that's certainly a lot of weakness, and this, again, is a very aggressive sell-off. So 5,400, so this right here is really going to be that first level of support for us to watch. However, my personal opinion, I think the bulls are not going to be able to hold that level for very long. There is a possibility that we do see some additional selling pressure, and I would not be surprised if we do sell off below that level. In other words, we break down below that support. And again, the next target is going to be 5,200. So right now we're down about less than 5% from all-time highs, so we're still well within a dip for the market. In case we get a breakdown below this, the next target is going to be 5,200. It's going to put us down over 8% from all-time highs. Still not in a correction, but we are going to be in a strong pullback for the markets, and a level that we have once again seen from back in June, more or less a little bit in the August, although we did gap down quite heavily, then push right back up, and that's going to be that next support. And the reason why that aligns so well is because of the horizontal support and also a higher low. So if you essentially scroll back a little bit, this is the higher low for S&P 500 at 5,200, right? So 5,200, that's going to be that level to watch for S&P. So first 54, then 52, then we have 51. That's the August low, right? So if we take down the August low, the August 5th low, then you better believe it, the markets are in a strong downtrend, because then that would confirm a new lower low. That would be a lower low. So lower highs and lower lows, that's exactly what the markets do not want to see. That's exactly what the bulls do not want to see. So that's going to be that next support down to as low as 49.50 for S&P 500. So those are some levels. So 5,400 down to 52, down to 51, down to 49.50. And 49.50 is kind of aligned with the level from back in April. Same thing is going to be true for the NASDAQ. This right here is the overall breakdown. And the first support sits at this higher low. And that's going to be coming up next week at around 16,450 or 16,500 to be rounding up a little bit. And that's going to be aligned with this previous resistance. We essentially consolidated sideways for the NASDAQ here for quite some time before selling off. And then once we broke out, you can see that that level turned into a support. Very, very small support, but still a support for the market before ripping up to new all-time highs. So we've got a horizontal support as well as a higher low for the NASDAQ, and that's going to be 16,000, call it 450, just to round up a little bit. And if you do break down below this, which again, there is a possibility because nobody really knows how far, how deep, or how long this sell-off is going to be. Next support is going to be down to 15,750. So this right here is going to be that August 5th low. And if you get down to that level, then again, things are going to get very, very serious for the market. Now, coming over to individual stocks, starting with Apple, a lot of consolidation. Once again, very similar to the S&P 500. What we have really witnessed is a little bit of a lower high for Apple. And you can make a case that this right here was a bit of a lower low. So, you know, a very small downtrend that could be in play here. And we've got a reasonable resistance, support, and a support that's sitting at 216. So if Apple, for any reason, breaks down below 216 next week, next potential target is going to be down to 207, down to as low as 196. So those are the three levels that I really want you guys to watch. 216 first, down to 207, down to 196. And right now, pretty much every single stock out there, especially the Magnificent 7, technology, and semis, are weak. They are weak. Coming over to Tesla. And Tesla had a pretty brutal sell-off. That's one of the reasons I sold calls in the first place, is because Tesla's got so much supply. It's got so much resistance that it's unable to break out of those levels for a really long time. We've still got lower highs and lower lows for Tesla, and a very strong resistance sitting at $233. That's exactly where we got rejected. If you take a look where we were for the high of day, 233.60. That it's already been on the chart for a very long time. We've identified that resistance for such a long time. And support level now is going to stay put at $208. So this right here is going to be that level to watch in case we get a breakdown below this. We've got a massive demand sitting roughly in the 180s, 190s, 180s. Lot of consolidation sideways in that range for Tesla. So it's really been range bound. For that very reason, I think it's been one of the best stocks to be trading the wheel on options because of how much there's been consolidation sideways. And the premiums have almost always been so juicy for Tesla. So support levels to keep in mind, $208 going into next week, down to this area of demand in the 180s, and a resistance staying put at 233 for Tesla. Coming over to Amazon, and Amazon breaking it down. There was a little bit of a head and shoulders, formation, and, starting to break down below 173. Next target's going to be down to 166 for Amazon, so that's going to be that level to keep in mind, and a resistance all the way up to $181 per share for Amazon. Moving forward, finally coming over to Meta Platforms, and we're only really coming over to Magnificent 7 here in this video. So Meta here also starting to roll over. This should not come as a surprise because we were talking about this huge resistance for Meta, that area of supply that it's unable to break out of. You know, a couple of times we've gotten rejected perfectly, and it's on its way lower, down over 3%, back down to low 500s. And in my opinion, there is potential for more downside for Meta. However, there might be an intermediate support here at 479. So you can see that we, somewhat consolidated sideways here at this level for some time before finally gapping down, which then turned into a bit of a resistance. So Meta really, on a more long-term basis, is consolidating sideways in that range where, it kind of gaps up here, 420 resistance, 420 support, then we got a 540 resistance, coming back down, going back up, coming back down, going back up, coming back down, and it's really been the range within which Meta has been trading. So next support down to 479, 480, down to 458, down to 420. Now coming over to Google, and Google has definitely been incredibly weak and so is Microsoft. Both of these companies very, very weak here. A little bit of a bear flag formation, which we discussed in our previous updates. You know, was selling off quite aggressively here, then a bit of a bear flag, and then broke down even further. And the next support is exactly where Google is trading now, inside this green rectangle, sitting roughly at 153, right? So 153, 152, that's where we are. In case we get a bigger breakdown, which again is possible for Google, although I do believe that it's a little bit more unlikely because it's already down, you know, close to over 22%. So it's already in a very nice bear market. But if it does end up selling off down to 129, that's going to be over a 30% sell-off for Google, which is a little bit unusual. But again, it has happened before. So, you know, you'll notice from 2021, it ended up selling off over 44%. So pretty much almost got cut in half. And this is a $1 trillion company, right? Well over $1 trillion, almost $2 trillion. So it is possible, but a little bit more unlikely. So if it does end up breaking down below this area of demand, next support is going to be down at 129. So next week, we'll see if Google can kind of hold up this level or if it breaks down further. And finally, we come over to Microsoft, and then we'll take a look at NVIDIA. Microsoft still has a bit of a head and shoulders, as we have discussed in our previous updates. A very strong area of demand and support sitting roughly here in the low 400s with a massive resistance at 432. Similar to Google, Microsoft also is down in a bit of a correction, over 14%. Can it break down below 400? Absolutely, there is a possibility that it does, and the next target is going to be down at 365, which is going to put Microsoft also in a bit of a bear market moving forward, down over 22%. So first area of support and demand sitting roughly at low 400s, next target down to 364. And finally, we come over to the star of the show, which did most of the selling last week, NVIDIA, and the next target and support that I have for NVIDIA is $96. I think we have to be prepared mentally that NVIDIA can trade down to $96, and from its all-time highs at one point, it's going to be down over 32% if it trades down to $96. But that's really where I'm expecting NVIDIA could potentially be. Again, at the end of the day, this is not financial advice. This is simply my expectation of what the price action may or may not do going into next week. At the end of the day, like I said, nobody really knows what the price action is going to do, what the markets are going to do. But this right here is going to be that next support for NVIDIA, which mentally I'm prepared to see. So hope you all enjoy this video and a complete technical breakdown on the S&P 500, the NASDAQ, and Magnificent 7 stocks. Let me know your thoughts down in the comment section below, and hopefully this gives you a little bit of an insight on how to move forward for the upcoming week. And make sure to drop a like, subscribe to the channel. Links to our Discord and Patreon is going to be down below if you want to join, be a part of our MoneyVest community. And as always, happy investing. I'll see you all in the next video.